Hi everyone. In the last lesson, we challenged one of the biggest assumptions in software. We saw that AI companies aren't simply software businesses with an AI feature. They are businesses that continuously buy compute, convert it into intelligence, and sell that intelligence to customers. Once you start looking at AI this way, something interesting happens. Many of the metrics and mental models we have realized on throughout our product career suddenly become incomplete. And that raises an important question. If AI businesses operate differently, can we still use the same playbook we learned in SaaS? The answer is yes, but only partially. Some ideas transfer beautifully, others become surprisingly dangerous. And that's exactly what we are going to explore in this lesson. Let me ask you another question. Imagine two companies, both make $10 million in annual recurring revenue, both have identical retention, both have identical customer growth. Which one is healthier? If you've worked in SaaS, you'd probably say they're almost identical. But in AI, one company could be making millions in profit while the other is quietly burning cash every single day. The dashboard looks identical, the economics are completely different. That's because AI changes something SaaS rarely worried about. Every user behavior now has a cost attached to it. Traditional SaaS taught us a beautiful business model: acquire customers, keep them happy, let retention compound. Eventually, margins take care of themselves. Why? Because serving one additional customer costs almost nothing. Once software is written, it can be copied infinitely. AI breaks this assumption. Let's look at six pieces of advice every SaaS PM has heard. None of them are completely wrong, but all of them become incomplete in AI. Think of this as learning chess after years of playing checkers. Many pieces look familiar, but the rules have changed. SaaS rewarded engagement. More engagement usually meant more stickiness, more retention, more revenue. AI introduces another variable: cost. If pricing stays fixed, every additional prompt eats into your margin. Suddenly, your most engaged customer might be your least profitable customer, and that's a completely different optimization problem. SaaS companies often operated with 70 to 80% gross margins. AI companies frequently launch closer to 40 or 50%. Why? Because costs move with customer behavior. Every conversation, every generation, every workflow changes the economics. Gross margin is no longer a finance metric, it's a product metric. In SaaS, a free user mostly consumed storage or bandwidth. AI users consume intelligence. Imagine every GPT-5 level reasoning away for free. Every curious user now creates real operating expenses. A free tier isn't simply a growth strategy anymore, it's an investment decision. Product managers usually think about latency as user experience. AI adds another dimension: cost. Faster inference often requires keeping expensive infrastructure warm. Better quality often requires larger models. Lower cost often means slower or smaller models. Every product decision now becomes a trade off between speed, quality, and economics. This course isn't asking you to abandon SaaS metrics. They're still useful, but they aren't sufficient anymore. AI product managers need another dashboard, one that explains not only how customers behave, but what those behaviors cost. And that's exactly what the next five frameworks are going to give you. Here's the mindset I want you to leave with. Every traditional product metric now has an economic twin. Engagement must be paired with compute cost. Retention must be paired with margins. Growth must be paired with unit economics. AI hasn't replaced product management, it has expanded it. Before today, you probably believed that more engagement always meant a healthier product. From now on, I want you to ask a second question: is that engagement creating value or just creating cost? Because once you begin looking at AI businesses through that lens, the next question naturally comes, why do some AI companies seem structurally better positioned than others? That's exactly what we'll explore next.